get used to where things are located or how to use your publication 4012. There is a glossary that can help you find things. There's the index, there's a table of contents, and there's also tabs. So the tabs are really good because they're kind of in order of how you enter things on a return. There's the people, then there's the income, and then there's the credit. Also, it's available online. And if you open up a PDF of it online, you can search for keywords, which makes things a lot faster to find things as well. You don't have to memorize anything. You just have to know where to look for something. And remember, you will have people at the tax site there to help you. If you haven't already done so, you really should put a post-it note on these pages in your book because you should be using these pages all the time. And we talked about these last time. It's B13, the decision tree for figuring out the correct filing status, and page C3 for dependents, who can and cannot be on the tax return. Remember to always start at the top and remember those specific rules about who can live where. Okay, so try this one as a quick review for yourself. Go ahead and pause this, read the question, and what do you think the answer is? Don't just let it go to the answer, pause it for a minute. No, she cannot claim her as a dependent. She doesn't pass the qualifying child test because she's not in college, and she doesn't pass the relative test since her income is too high. Try this one and make sure you pause it. Kenny can file head of household. Yes, he's legally married, but since he did not live with his wife the last 6 months of the year, he can file head of household because he paid over half the cost of the home and he has that qualifying child living with him. I hope you used your decision tree because a lot of people would put married, joint, and married separate. Now, if he's going to file head of household and they're legally married, how is Dolly going to file? Married separate. If she has nobody else that lives with her that she can claim as a dependent for that head of household, then she has no choice but to file married separate. So Marcus is a little different case. Read through this and I want you to think, do you have enough information? So read this scenario, pause it. So hopefully you realize that you definitely need more information. We need to know, is he still married to her legally? Did they get a divorce? Is she even alive? And based off of the answer we get, we still need more information. Um, if she's legally married, if she's legally married, we'd want to know, do you want to file with her or not? And based off how he answers that question is going to help us determine his filing status. So they've not been together the last 6 months of the year. They're legally married. What do you think? If he says, I do not want to file with her, what would his filing status be? And use your decision tree. And pause this. So how many of you said had a household? How many of you said married separate? Most people choose head of household because of that last scenario we just looked at. But unfortunately, grandparents do not meet the rule for this. If you look at your decision tree, the very last thing towards the end of that big box, on the right-hand side, grandchildren do not meet this test. So grandparents who are legally married, even if they do not live with their spouse, cannot be head of household. If they're legally divorced, you're going to need to know, when did they get divorced? And if she's a widow, you need to know, when did she pass away? And depending on how he answers that question, when she passed away, is going to determine filing status as well. pay very close attention to those two big boxes because more than likely you're going to get this wrong. Most people get these questions wrong. If she passed away in the first or second year, or sorry, 1 or 2 years before the tax year. So if you're doing a 2024 tax return and she passed away in 23 or 22, go ahead and pause this. Let's say she passed away in 2022. What would her filing status be? Or what would his filing status be? Thought I would have it there. Most people put qualifying surviving spouse. But if you read that box at the very bottom, grandchildren do not meet the test for qualifying surviving spouse. Another way grandparents are not taken care of. And so in this case, if she passed away in 22 or 23, she was not alive in 24, then basically he's a single parent kind of a thing. And so he could be head of household. If she died during the tax year in 2024, what would his filing status be? Again, use your decision tree. Pause this. He would have no choice but to do married joint or married separate. And if she died in 2025, when you're doing a 2024 tax return, pause this. She was alive on the last day of the year. He has no choice but to do married joint or married separate. All right, types of credits. So there are two categories of credits. There's non-refundable credits and refundable. Now, I want to say moving forward, you're not expected to memorize any of this. I just want you to become familiar with how they work and how to look them up in your book. So the sections in your book, the publication 4012, that we are going to discuss in this session are sections G, I, and J. And the screens will tell you what sections they're in. The computer will pick the right credit that they are entitled to. It's all based off of age, relationship, income, filing status, those kinds of things. If you enter the people, their filing status, and the money correctly, the system will determine the credits. But you kind of need to understand it and how they work. So first of all, you can explain a return to somebody, but then to also realize maybe when a credit's not there that it should be, maybe you did a typo. But you don't have to memorize anything. So the last return we just looked at for Miss Amy Yeager, the very top section, 16 through 24, is the taxes and what's called non-refundable credits. So her tax was $1,844. That was her income tax liability. She received $1,000 in credits. Those type of credits that you see on the top of page 2, those are called non-refundable credits. All they can do is pay any income tax liability that you have. It can also cover not only income tax liability, but marketplace repayment. So whatever's on line 18, that's all it can cover. If the credit is more than the tax, it'll just cover that amount. So the most Amy can get for non-refundable credits is $1,844. Types of non-refundable credits are child tax credit, credit for other dependent, which is what these two dependents got, child and dependent care, which is daycare credit, some education credit, retirement credit, there's credit for the elderly, energy credits, and foreign tax, and there's more. Refundable credits are the best because whatever isn't used to pay a tax liability gets refunded to the client. They're very, very powerful and they're very valuable. And because of this, there's a lot of fraud that takes place. So the IRS looks at these credits just a little more closely. Errors and frauds can result in hefty fines to the taxpayer, lots of penalties, but also they can be banned from getting these credits again for a good period of time, several years actually. And then, of course, there's always interest that they have to pay it back. Refundable credits are the earned income tax credit, the additional child tax credit, There is a refundable part to the American Opportunity Tax Credit, which is an education credit. And then Marketplace can also issue a refundable credit. Child tax credit. So these credits that we're going to talk about now can be found in tab G. To qualify for the child tax credit, the dependent has to be under 17. They must have a social security number, and they have to have lived in the United States for over 6 months. The amount of this credit that they could get is up to $2,000 per child as a non-refundable credit. It's a wonderful credit. So anybody who passed the qualifying child test on the left-hand side of C3, who passed that test, who's under 17, has a social, and lived in the United States for over 6 months, you can get a $2,000 credit for that child. Of course, all it's going to do is pay that tax liability. And then whatever's left over, they kind of lose. Except there is a possibility they might get some of that refunded, any of that leftover amount, as long as they meet the criteria for what's called the additional child tax credit. So the additional child tax credit has the same criteria for the most part. They have to be under 17, have a social, live in the United States for over 6 months, and the person trying to claim them, the taxpayer, must have at least $2,500 in earned income. If there's over $2,500 in earned income, they could get they could get all or a portion of the credit that was not used of that 2,000. It is based off of a percentage of income to a certain amount, but the most they can get is $1,700 per child. So whatever the unused portion is, up to $1,700, as long as their income is at least $2,500, and if it's really low, they'll only get a little bit. It's all based off of a calculation. So it's pretty nice. Then there's the credit for other dependent. So this is for all the dependents who qualified on the right-hand side. Those are your qualifying relatives, plus anybody who qualified on the left-hand side who is 17 or doesn't have a social. And they're not related to like your children, they're your parents or your friends. So basically a qualifying relative or a qualifying child who's already 17 or has an I-10. And the most you're going to get is $500 non-refundable credit. So all it can do is pay your tax liability, but $500 to pay your taxes is pretty sweet. So the difference is for those credits is how was that dependent classified? Were they a qualifying child or were they a qualifying relative? And what is their age? So under 17, have a social security number and live in the U.S. If you say yes, it could be up to $2,000 and may possibly qualify for the refundable child tax credit and the earned income credit, which we haven't talked about yet. Test for the qualifying relative or anybody who failed the test there on the left is up to $500. And you can see what the dependent qualifies for right there on the very front part of the 1040. The little boxes show you what they qualify for. And this is also kind of a good thing. If you have the 8-year-old child who has a social security number and the box for credit for other dependent is checked, you might want to go back and see if you made a mistake. So it's a good way just to kind of check for some quick errors. Now, the best credit, the Earned Income Tax Credit, or EITC. Keyword here being earned income. This credit was designed to boost people out of poverty, and you must have earned income. That means you work for it, blood, sweat, and tears. You also need to have a social security number. The parents, the taxpayers have to have a social security number. Excuse me. The dependents do not. Must be a U.S. citizen or resident alien all year. meaning they have to live in the United States. The most they can get is $7,830. That's a lot of money if they have 3 kids and they're married. It can be as little as, I'm sorry, the most you can get if you do not have a child is $632. So you don't have to have kids to get this credit. There's criteria for people who do not have kids. They can get this because, again, this credit's designed to boost people out of poverty, not just people with kids. How this credit works is all based off income. You don't work, you don't get it. You work a little, because you'll see this curve here going up. You work a little, you get a little. So the credit grows with you as a way to encourage you. Hey, you worked, you made a little bit more, we're going to give you a little more of this credit. That's going to help them. Eventually it plateaus. Your income goes up to a certain amount, it plateaus, you hit it levels off. That's called the sweet spot by a lot of people. It's the most you can get for the number of kids or filing status. Then, as your income continues to go up, the credit starts to come down because you don't need it as much. So it is a really good credit. Helps so many people. For, you know, our average income that we serve is around $27,000. And to get thousands of dollars on a tax return from this credit alone, for some people, you saw that 1,400, but I've seen $3, $4, $5,000 in these credits. That's a huge amount of money that has a huge impact on these families. It's a wonderful credit. But again, there's a lot of fraud involved. Years ago, married filing separately could not get this credit, but the last couple of years they do allow it. And earned income tax credit, I forgot to mention, the whole tab I in your publication 4012, the whole tab I has to do with this credit. Married filing separate status could possibly get this credit now, provided they meet this certain criteria. And this is in your book as well. Number one is they have to have a qualifying child living with them for more than half the year. They have to have lived apart from their spouse the last 6 months of the year. So before July 1st, they had to have been separated from their spouse, not spend one night together. They do not need to pay over 50% of the cost of the home. So they could be living in someone else's house. They don't have to be at a household. But they cannot be living with their spouse the last 6 months of the year in order to get this credit if they're married. The thing is, usually they can't get this credit. So if they are entitled to this credit and they're married filing separately, you need to make sure you check the box underneath their date of birth. That whole list of little boxes on the demographic screen, there is a box for married separate, qualifies for the credit. So don't forget to check that. For age requirements, if somebody has no kids, they have to be at least 25 but under 65 by December 31st. So if they don't have any children, whether it be husband and wife or a single person, they need to be under 65 or over 25. And one spouse, both spouses don't have to be over 25 and under 65 if they don't have kids, but at least one does. And as long as their income falls in line, they could possibly get this credit. In order to get this credit, the child must meet the relationship, age, residency test, and joint return test, but not the support test. And you do not have to claim them as a dependent. And this really confuses a lot of people. So again, there's a relationship, a very close relationship. It has to be your child kind of a thing. So this close relationship, and look in your book on page I2 for this chart, there's this age, residency, meaning they live to you, and that's very, very important. Make sure you flip to I2 and kind of go over the requirements for this credit. The child must meet the relationship, age, residency test, and joint return test, but not the support test. The child does not have to be the dependent of the taxpayer claiming them. And this really gets confusing. Let's go back here real quick. For this credit, there has to be a close relationship. The age test needs to be met, and the residency test. And that's a big thing, residency. The child has to live with the taxpayer. So you could have a couple. Let's just use mom and dad and a child. And let's say they're divorced. And let's say the child lives with mom for more than half the year. But the divorce decree says that dad gets to claim the child as a dependent. Well, a divorce decree can say who can claim the child as a dependent, which would entitle dad to the child tax credit. But that's it. A divorce decree does not indicate or say filing status or earned income tax credit. Those are specific to who does that child live with, or do they have a child living with them? Are they married? That kind of stuff. So for earned income tax credit, if the child lives with mom, dad can't get that credit for that child for earned income tax credit. So he would do his return, he would list the child on the return, but he has to check the box does not qualify for the earned income tax credit. Mom can't take the child as a dependent, but since the child lived with her for more than half the year, she can put the child on her return and check the box does not qualify as a dependent. And she can still get the earned income tax credit if all the other qualifications are met. And she could file head household as long as she meets all the requirements for that. I-4 here is this great tool that I use quite a bit when somebody is, we're discussing earned income tax credit. On the right hand side, you can see the income limitations as to how much can you make with the number of children you have. At the very bottom of that, $18,591 is how much you can make as a single person with no children and still get earned income tax credit. So up to $18,591. If you're married filing jointly with no kids, you can make up to $25,511 and still get some credit. And again, how much you get is based off how much you earned. So the more money you have, the credit goes up and then it starts to come down again. If you're married, your spouse also has to be working if you're filing a joint return. One can't stay at home and you put your kid in a daycare, and you can do that, but the IRS isn't going to give you credit for that. If you have a parent staying at home, they should be able to take care of their own kids. You can pay for daycare if you want because you don't want to be bothered, you have errands to run, whatever, that's fine, but you can't use that for a credit. It can also be to attend school full time. Paying for school, kindergarten, like a private school where you have to pay to go to school, can't count that. But before school care and after school care counts. Summer camp, if they go to summer camp because school's closed, you need somebody to watch your kids, you can't have, a second or third grader running around while you're at work. That's okay, but not a sleepaway overnight camp. The only people that can take the credit are the custodial parents. So whoever the child lives with gets to take the daycare credit. You can pay a relative to watch your family members. Of course, you can pay whoever you want, but the IRS is not going to give you a tax credit for all your relatives. So you can't be able to claim, if you're paying somebody to watch your children and you can claim that person as a dependent, you can't take the credit. Whoever you pay also has to report that income that you pay them on their tax return. You can't pay somebody who's your child under the age of 19, even if you don't claim them as a dependent. So you can't pay your 18-year-old daughter to watch your 12-year-old son. You can't do that. You can do that, but you can't take it for a tax credit. So anybody you can put on your tax return that you pay to watch your kid, you can't get a credit for that. You can't pay your spouse to watch your kid and get a credit for that. You can pay them, but the IRS isn't going to give you a credit for that. You can pay the father or the mother of the child to watch their kid. Maybe it's, maybe they're divorced and um, you want to pay the father to watch the kid so you can go to work. You can do that, but you can't get a credit for paying the parent to watch their own child. In your book on G12 through G16, it talks about daycare credits or dependent care credits and who can use these credits. So, first of all, you can pay whoever you want to watch your children or to watch your family members who are disabled. That's okay. Doesn't mean the IRS is going to give you a tax credit for it. There's certain criteria that needs to be matched. So, first of all, the child that you're paying for the daycare for needs to be under 13. However, if they are over 13 but permanently and totally disabled and cannot take care of themselves on their own, and you have to work in order to make money to pay for food and rent, and you have to pay somebody to take care of your child, that's allowed. So anybody over 13, as long as they are permanently and totally disabled, it could be your child, but it could be your spouse as well, somebody who lives in your home. And your spouse has to be physically or mentally incapable of self-care. And they don't have to be um, basically a dependent. It doesn't have to be a child. It can be somebody else in your home. So they have to live with you for more than half the year, can't take care of themselves, or under 13. The whole purpose of this credit is to help people who need to work to make that money. Daycare is very, very expensive. It's extremely expensive. And so it's just kind of a way to help alleviate some of that. You could find education credits in section J of your book. It's a big section. Well, it's not big, but it covers the American Opportunity and the Lifetime Learning. Both credits have a non-refundable portion, and the American Opportunity has a refundable portion. So who can claim an education credit? Taxpayers who paid qualified educational expenses for higher education like university, trade school, local colleges, people who paid for that for themselves or for their dependents can try to file for an education credit. Except married filing separately does not qualify. That's just one of the rules. Married separate. There's a lot of things they can do, and this is one of them. They can't take an education credit. If the student isn't claimed as a dependent, even if they're eligible to be claimed as a dependent, then only they can take the education credit. So if mom and dad choose not to claim their child as a dependent, then they can't take the education credit for that dependent, that student. If that dependent student chooses to file their taxes and mom and dad are not claiming them and they try to take an education credit, chances are they're only going to get the non-refundable portion. Of course, there's exceptions to every rule, right? So answer the questions carefully. But generally, if their parents are alive and they're under 24 and they file their own taxes and their parents are not claiming them, they are not entitled to the refundable credit. But answer the questions correctly in the system and it will figure the credit out for you. What expenses qualify? Expenses paid for an academic period starting in 2024 or the first 3 months of 2025. Expenses that are not refunded. So if they withdraw from the class and they got their money back, they can't claim that. And anything that they paid for, any school expenses they paid for with a student loan, because a student loan is their money. What expenses qualify? Expenses paid for an academic period starting in 2024 or the first 3 months of 2025. Because a lot of times you have to register and pay for the January start of school. Expenses that are not refunded when the student withdraws. So if you pay for a class and then you withdraw and the school gives you your money back, well, you can't claim that money that you originally paid on your tax return because you got your money back. And any expenses that were paid through or by a loan that you got. So if you took out a student loan to pay for your school, well, guess what? That's your money. If you use that to pay for your school, you can claim that. Some people think you can't, but it's actually your money. You have to pay it back. So you can use money from a loan that you paid for expenses. You can claim that as long as it was for school. So on page J8, there's a comparison between the two credits. American Opportunity is the absolute best credit. Lifetime Learning is also a very good credit. So here are the differences. Again, the system does all this for you. You just need to kind of know. Just hear it at least once and know where to look. American Opportunity is up to $2,500 per eligible student. Lifetime Learning is up to $2,000. American Opportunity has a non-refundable and a refundable portion. The Lifetime Learning is only non-refundable. American Opportunity is not refundable. So it says none of the credit is refundable if the taxpayer is age 18 and their earned income is less than half their support. So if I'm 18 and I'm going to college and I make money, but my money is less than half my support, I can't take the credit. If I'm a full-time student over 18 but under 24 and the amount of money I make is less than my half of my own support, I can't take the refundable portion of the credit. If I have one living parent and I'm under the age of 24, I can't take the credit. And if I'm filing a joint return with my spouse, I'm sorry, if I'm married but I'm not filing a joint return with my spouse, then I can't. American Opportunity is not for graduate studies. Lifetime Learning credit could be for graduate studies or just to improve your job skills. So American Opportunity is your associate's and your bachelor's degree, but not master's and not doctorate. It can also be, American Opportunity can also be for a certificate. You're working towards a certificate or a degree. American Opportunity can only use it 4 times in your life. Lifetime Learning, keyword lifetime, unlimited number of times as long as you meet the qualifications. American Opportunity, again, you're working towards a degree or certificate. Lifetime Learning, you could be working towards a degree or certificate, but it's not required. With American Opportunity, you must be going to school at least half-time for 1 semester. So that's locally. I've contacted all of our schools, FGCU and FSW, and Hodges. I don't think they're open anymore. But 12 credits was considered half-time. For Lifetime Learning, it could just be 1 course. There's no minimum requirement. And I do want to say Lifetime Learning could be improving job skills. So working towards a degree or improving job skills. I think I said that. All right. For American Opportunity, it's such a great credit. We're not giving it to those little felony drug dealers. So any, felony drug conviction, nope. Lifetime Learning, it doesn't matter. Qualified expenses. So books, supplies, anything you need that's required for your schooling. It could be paper, pencils, ink if you have to print stuff, whatever you need for your school. And it doesn't matter where you buy them for American Opportunity. For Lifetime Learning, it's what's required for school, but you have to buy them from the school bookstore. When you enter the education credit in the system, there's 3 boxes you're going to fill in the dollar amounts. So tuition paid, you're going to put the tuition there. Grants and scholarships, you're going to put that there, and other qualified expenses. So, other qualified expenses is what is needed and required in order to take that class. So, tuition, obviously, you need that, right? Um, Other things could be lab fees, books, supplies. If you're in an art class, it could be art supplies. There are like 6 different entry screens for entering an education credit. You're not done entering an education credit until you see this screen. The system will tell you what credit you should choose. Say we recommend whatever, um, whichever credit you want to take. Make sure it's highlighted in green. You can see it. Make sure it's checked, and then hit continue. So no credit. In this case, you could have an $804 credit or a 2,500. I think we're going to go with the 2,500. But you're not done until you see this screen and you hit continue. That's just an FYI. Let's talk about Marketplace. What is Marketplace health insurance and why does it need to be reported on a tax return when other health insurance doesn't? People ask this all the time. So, why does it need to get reported? Well, first of all, Marketplace for our clients is called subsidized health insurance. It's usually subsidized. And that means the government pays part or all of the cost of that health insurance policy for them. How much the government pays is based off of the income that the taxpayer thinks they're going to make. And it's based off of where they live, what zip code they're in, their age, the medical policy that they chose, their family size, and their expected income for the upcoming year. So nobody really knows exactly how much they're going to make. So the reason why this has to go in a tax return is because when do we know how much we make? When we file that final tax return. And that's when we reconcile what did that policy actually cost, how much did the government actually pay for it, and how much did you actually make? And based off of that, that's going to determine whether the government paid too much of it for you and you have to pay some back, or they didn't pay enough or they could have helped you out more and they're going to owe you money back, or maybe you break even. All you have to do is just type in the information on the form. The system will do the rest for you. But nobody really knows how much they're going to make until they file a tax return. So let me give you an example. So when you go to sign up for Marketplace, you have to sign up in November or December for the coming year. So right now, this is November, December of 2024, and we're signing up to have health insurance in 2025. And they're like, where do you live? And what's your family size? How much do you make? How old are you? Which policy do you want? And based off of that, they're going to say you can afford to pay X amount of dollars. Let's just say, I'm just going to make up numbers. I call them up. I say I need insurance. I think I'm going to make $30,000. The policy I chose costs $1,000 a month. Just making this up. And I say, okay, based off of your income and your family size and everything you told me, you pay $100 a month. We'll pay the other $900 a month. This is totally just simplified. Let's say I make more than I projected. I had a great year. I worked overtime, got a second job, whatever the reason. I won money gambling at the casino, who knows? But I made more than I told them. Then I could have paid more of my own insurance. I could have paid more than $100 a month. So they're going to expect me to owe some of that subsidy back. The reverse is true though. Let's say family members or myself got sick, we couldn't work, or the hurricane came and our businesses shut down or got destroyed. Whatever the reason, I couldn't work. I didn't make as much as I thought. I made less than $30,000. Then they could have helped me out and paid more of my insurance for me, so I should have paid less. So they're going to owe me money. And sometimes what we project is very close and nobody owes each other. It has no effect on the return, but it still has to be filed. We have to show that we reconciled the information. This is what a 1095A looks like. This is the top part of the form. Part 1 is just the basic information on who bought the policy and what the policy number and who it's with is. Part 2 is who is covered under that policy, who is actually on that health insurance. It's extremely important that you look at who's in part two. That's really crucial. If there is somebody in part two that is not on that tax return, you need to stop and you need to talk to your coordinator or contact me. You can't do a return if there's somebody on this policy that's not on the tax return. Because remember, this has to get reconciled and they could be on a different tax return. And we have to be able to take this information and split it, that's called allocate, between two different tax returns. That's complicated. We're not supposed to do it. So if you have somebody come in that has somebody on this policy part two that is not on the tax return, stop and reach out to me and we'll talk about it. It is absolutely okay if there's people on the tax return that are not on this policy. Maybe there's 4 people on the tax return, but this health insurance policy from Marketplace is only for one person that's on that return. That's okay. It's okay to have more people on the return that are not on the policy, but it is never okay to have somebody on the policy that's not on the return. Remember that. The bottom part, part 3, has all the information about the dollar amounts for that policy. So column A is how much that policy that they chose actually cost. B is just a different policy that they use for calculations. And part C is how much the government actually paid every month for that policy for that person. So A is what it cost and C is what the government paid for them already. Sometimes they'll come in and this form will not be all the way from January to December. Sometimes they'll have multiple forms, and some months might be on one form, some months might be on another. There's also sometimes where one person in the family will have one form and then there might be a different form for somebody else. Anytime you have situations where there's multiple months, that's a special situation. So let's say you have 2 forms for the same month. Use your book, talk to your coordinator. If you're with my program, contact me on how to handle that. Your book shows you how to do that, section H. But we don't see that very often. But if you have a form they hand you and it's only for a few months, like I had one yesterday that was from June to December, you ask them, did you have insurance from January to May? They possibly did, they just don't have the form. And so if you're ever in doubt, they can always call Marketplace right there on the spot. They're open 24 hours a day. What we do is we look at columns A, we make sure that the same number is from January all the way through December. If it is, wonderful, then we do the same thing for B and the same thing for C. If it's not exactly the same, then we have to key in every single box, and I'll show you what I mean in just a moment. So again, when you're looking at the form, you need to know who is covered, and then the bottom, part A is how much does that policy cost, and C is what did what the company paid, what the government paid is what it should say. So here's an example of one. We have Harris, Carly, Billy, and Christina listed there. Remember, if there's somebody on this policy that's not on the tax return, it's out of scope. So looking at this, we have Betty. The policy is for Betty in part 2 down there. Can we do this return? Yes, we can, because the same people are on the tax return that are on the policy, and that's okay. We have Betty listed on the intake form. On the policy, we have Betty, and we have Samantha, and we have Fred. Can we do this return? No, we cannot, because Samantha and Fred are not on the intake form. They're not going to be on the tax return. Over here, we have Betty on the intake form, and down below under dependents, we have Samantha. So we have 2 people on there. Looking over on the Marketplace form, we have Betty and we have Samantha. Can we do this return? Yes, we can, because both of these people are on the tax return. So Marketplace, also called the Affordable Care Act. If you ask the client, did you have Marketplace health insurance? More than likely they're going to say, no, I did not. Don't ask that question. You're going to click no in the system. You're going to transmit the return. And guess what? It's going to get rejected. You're going to be like, "Ugh, they told me they didn't have insurance." Or if I go talk to the tax preparer, I'm like, they had insurance. They told me they didn't. The reason why this happens, and this is like the number one reject nationwide, is people have Marketplace, but they're telling the computer that they don't. And here's why. Is they're not intentionally lying. They don't know that the health insurance that they have is actually Marketplace health insurance. When it first started, President Obama made Marketplace come to life, and so it was called Obamacare, and everybody called it Obamacare, and everybody knew that what they had was Obamacare, was Marketplace. They knew that. Well, it's been many years since Obama was in office, and there are many people selling the health insurance now. And when they're selling it to people, signing them up, they're not telling them that the policy that they have is called Marketplace, is through the Marketplace. They're just saying, oh, you have United. Oh, you have Blue Cross and Blue Shield. Oh, you have this, or oh, you have that. They don't understand that the health insurance they have is actually Marketplace health insurance. So it's not that they're lying to you, they just don't understand. So don't ask, do you have a Marketplace? The better question is, where did you have your health insurance last year? Did you have it through work? Did you have Medicaid, Medicare? Ask them something like that. If they're not sure, we can always call them. Marketplace is open 24 hours a day. You can find out while you're on the spot. You want to know, because if they do have it, or if Marketplace thinks they have it and we don't enter it, it's going to reject. One of the things I do when I call them or when I talk to the person is, where did you have your health insurance last year? Did you have it through work? If they say no, did you have Medicaid and Medicare? If they say no, I had it through, and whatever they say, I usually ask them at this point, how much did you pay? Chances are, if it's really low or free, it's Marketplace. So what I'll do is I say, I'm not 100% sure whether it's Marketplace or not. We can call them right now. They're open 24 hours a day, and they can tell us. If it is Marketplace and we don't enter it, your return's going to reject. I'm going to have to call you, and you're going to have to come back. So we can just call them now. If it is, we can get the information over the phone. If it's not, no big deal. And they're usually happy to make that phone call. I do have blank 1095 forms with the phone number for Marketplace written on there. And so they call while I'm entering everything in the system. By the time I get to that screen, they usually have the answer for me. Some tips when you're doing Marketplace: never ever change anything on the screen. Don't do it. Just hit continue. These questions, this first one's always going to appear. It's going to say, are you required to repay all of the advanced premium tax credit? Always say no. If they have to repay, the system's going to make it do it no matter what. If you say yes, you're going to force them to repay everything that's in that column C, which sometimes is is a lot of money. Sometimes I've seen it as much as 14,000, but regardless, just say no. If they're required to repay, it's going to automatically happen anyways. Sometimes if their income's low, you'll see this next question: is your household income below 100%? If that question pops up, just say yes. No matter what, just say yes. If you say no, you could be forcing a repayment. Just say yes. So if these two questions pop up, I like to say New York, because they used to pop up every single time regardless. Now that second question only pops up when the income is a certain amount. So are you required to repay? No. Is your income below 100? Just say yes. All right. This is what I was trying to talk about earlier. Be very careful in looking at this form. I always take my finger and I go down column A right here. And I make sure every single one of these every single one of these numbers are correct, are the same. If you have a blank or one number different in column A, then this question over here, do all forms 1095A Include coverage from January through December with no changes in monthly amount. So every single one of these is the same. And then you look at B, is every single one of these the same? And then you look at C, if every single one of these is the same, then we can say yes. And what's wonderful about that is then we can enter just these annual totals at the bottom here. But if one box is different or one row is blank, you have to say no. And then you have to manually type in all the numbers. Okay. So now you're going to do another return. In your book on page 106, we have Joe Lopez. Remember, highlight the forms, highlight everything you're going to enter. Pay attention to this box 2 here because a lot of people miss this. Okay, let's do another return. Open your book 6744 to page 106. Make sure you read the intake notes carefully. You look at the intake form, make any notes on there that you need to. Make sure you highlight any tax forms that you have. A little tip for you, whenever you're entering interest or dividends, you only have to enter the payer's name, who gave them that money. In this case, for this client, it's New Bank and Trust. See how there's a little star on the left there next to the payer's name? But there's no star next to the payer TIN or EIN. Skip those. All you need is the name and the money. Just fill in the boxes, name and money that you have on the 1099 INT form. A little tip. It'll save you a lot of time. When you do the marketplace, anytime you enter marketplace, this screen will pop up. This screen says household income, dependents modified AGI if there's a filing requirement. The only time you are ever going to enter anything here is if a dependent that they're claiming has a legal filing requirement. That means the dependent they're claiming made more than the standard deduction. Do they legally have to file a tax return? If they do, then we have to put their income on here. And the reason why is the government is helping to pay for insurance for your house, for your family. If your dependent is making that much money, then they can help pay for the insurance. Most of our clients, when they're claiming a dependent, don't make that much, but there are a few that do, so just be mindful of that. But most of the time, that's blank. When you're done with this return, the AGI should be $42,112, and the refund you're going to be getting to is $4,848. Remember, get all the way to the end, and then answer the questions on page 115. At home, you're going to review. These are advanced scenarios that you don't have to do a tax return for, but review advanced scenarios 1, 2, 4, and 6. And they start on page 75, and you just read it and answer the questions. And everything that has to do with those questions we've talked about today. And you can use your publication 4012, sections G, I, and J. Don't get overwhelmed. In real life, this is easy peasy. You'll do just fine. If you need assistance, email me or jump on my Zoom session.